Hello and welcome to this Money Marketing Wired session on what happens post-2018 when auto-enrolment contributions are up to their full level. I'm John Greenwood, Editor of Corporate Advisor, and I'm joined by a panel of expert guests. Jim Bly, Head of Public Services at the CBI, Chris Curry, Director, Pensions Policy Institute, John Monks, Trustee Director of Now Pensions, and Jonathan Lipkin, Director of Investment Management Association. We are live today, so if you do have any questions, please send them in by pressing on the button below this screen. And if you are tweeting, you can get hold of us on hashtag #MMWired. So, Chris, if I can start with you first of all. We all know that 8% is not going to be enough for most people's expectations. So how short will that leave us, and where will it leave us if we don't do anything post-2018?
It's a good question to start with. It depends very much, I think, on who individuals are and what their experiences are as to how much they need to save. The first question is trying to work out how much people actually need to save in order to have a comfortable retirement. If you take as a working definition that people really don't want to see a big drop in their living standards when they get to retirement, then some work which the PPI did last year highlighted the fact that, say you have a median earner who starts working at age 22, immediately joins, is auto-enrolled into their pension scheme, makes the minimum 8% contribution level right the way through until they reach state pension age, at age 68 for that 22-year-old individual, they have roughly a 50-50 chance of achieving that kind of target level of income in retirement. Now that sounds as if it's not too bad. Actually, we were actually quite surprised when we had that conclusion to start off with. But one of the key assumptions in that is that the state pension, the single-tier pension, when it comes in next year, is triple locked right the way through, all over that kind of 46-year period. If in fact it's only increased in line with average earnings, which is the stipulation which is in the Pensions Act, then actually that individual only has a 1 in 3 chance of achieving that adequate replacement rate. So you can see that people are much more likely to need to put in more than the 8% than to just rely on that. That same individual would probably need to save somewhere between 12 to 14% of band earnings if they wanted to just achieve that replacement rate income just using their pension saving. There are, of course, other ways they could do it, but if that's all they had, then probably you're looking at 14% rather than 8%.
Sure. And then if I could turn to you, Jim, from the CBI. 12 to 14% are employers the people who should be doing that?
It's important, I think, to remember where we came from. So before the Turner Commission, very, very few people were saving at all. And even today, I think it's 45% of women and 49% of men saving to a pension. So we're still at a point when most people aren't really contributing anything to savings and pensions, and very often can't afford to contribute anything to savings in ISAs or any other forms of saving vehicle. So what we need to think about is whether we can increase savings overall and rebuild a savings culture. But we're in a time where we've just come through an extremely difficult recession, and across the country the vast majority of people still aren't feeling the impact of growth and aren't feeling the benefits in their pay packages. Real wage growth has slowed. Very often it has stalled, and in some parts of the country that's much more pronounced than in others. So if we're going to try and increase the minimum contribution from the 8% overall that we have, with 3% from the employer and 4 plus 1 from the employee, we have to think very carefully about the impacts on people's already squeezed pay packets. So for us, it's about making the 8% work, encouraging people to get into saving and into pension saving for a start, and then let's have a look at what's happening with the economy and what people can sustain at the end of the auto-enrolment rollout period in 2018.
If I could just push you a bit further on that then, is that a CBI position that there's enough of burden on employers with the contribution they're already making, and that actually if the government, political parties come knocking saying yes, we'd like to take it further, your initial position will be no, thank you very much?
I think at the moment, and probably in 2018 as well, there'll be very strong pushback from employers. Lots of them are already very hard pressed to increase wages, but also to increase their pension contributions very often, as I said, from nothing. So to say, actually, thanks, you've done that now let's increase that minimum contribution even further. I think employees may very well not thank government or thank the employer for doing so. And employers, I think, would struggle to invest in their business, in jobs, and therefore in growth, which is really what they need to be doing at the moment. If you talk to the small businesses who are just coming into auto-enrolment, they're struggling with 1%. So they, as that goes up to 3, and as that goes higher, there will be even greater pressures on them, I think.
Yeah, sure. And Lord Monks, the Now Pensions, as a trustee of Now Pensions, what's your perspective on what should happen to contribution rates post-2018 once everybody's on?
Well, we all know that the 8% is not enough, I mean, there are some people for whom it probably will be enough, but there's a majority probably for whom it won't be. And so the actual rates of saving need to go up. Now, who pays for that? Obviously is a major question, and I don't think anybody is yet in a final position about what to suggest. We know that if you put it up for employees, you run the risk of opt-outs increasing considerably. At the moment, with the low figures that we're talking about, the opt-out situation is quite good. There's not many people opting out. But that could get worse, and it could get worse every time there's a significant increase, even up to 2017. So it's not just employers who will be reluctant. A lot of workers, as Jim said, feeling the squeeze on real incomes at the moment. I mean, real incomes have gone down since 2008, the crash that we had then. And persuading people to put money aside for their retirement in that circumstance is not easy. But having said that, long term, we're going to have to grasp a few nettles, and I think we're going to have to grasp the nettle that we need more than 8%. And some employers will do it, but I like to think that the ones who are progressive and can afford it will not be undermined by the ones who are not progressive, and that's always a danger. With this kind of choice, which is provided under which might be provided at the moment, is provided at the moment above the statutory obligations towards 8%. So yeah, I mean, it's a big decision, but I'm looking forward to that decision, and I think it'll have to go up.
And you're a former TUC representative,
yeah.
So obviously you understand the union and the sort of the grassroots employee perspective. You've got an insight from that angle. Do you think there is going to be pressure for maybe something towards political pressure for something towards the Australian model, where you've got not only compulsion but a long-term trend towards forcing employers or employees, obviously it's not decided who would be making increased contributions, to pay more in?
Well, I hope so, is the answer to that. I mean, auto-enrolment has had a good start, and it's got wide support across the political spectrum, unions as well as employers, supporting the work that was done initially by Adair Turner and some colleagues. I think I'd like to see that wide support continued. I think it's important. And I think, too, that as we look ahead, I think the Australian model is probably as good as any in the world at the moment for us to follow, and including compulsion, that there's not all this messing about by an employer about who wants to contract out, who wants to stay in. They're all in, and I think that is the right decision. I mean, I've been associated over the years with defined benefit schemes, excellent schemes, and you've still found 20% of people not paying in. So I'm not naive to think that there'll be a sudden surge of militancy behind a better pension scheme. It probably will be always lower than the real pay rates. But I hope that auto-enrolment will get people used to pensions, used to savings, and that we'll see it as a platform for more interest in doing things together by agreement on a better basis than are currently planned.
Thank you. And Jonathan, the IMA perspective, what's your perspective as where we are, and also what the policy options are going forward?
Well, I agree with what others have said, that 8% is a starting point, and I think the Pensions Commission, Lord Turner and his colleagues, were very clear about that. They were setting up a baseline replacement rate of private savings alongside a reformed state pension. So the question as to whether contribution rates will go up for many people is not a question of if, it's a question of when. If you take the Australian example, I think there's some very interesting experience there, because the majority of people in Australia do not make additional voluntary contributions beyond what is required, but the clear majority recognise that they need to save more. And I think that raises the question as to the mechanisms. And we're pretty open at the IMA. There's not a firm view that we have to go in one direction or another. Future governments may decide that compulsion is a direction of travel that they would prefer. But I think there are also other more voluntarist options that might be worth exploring, such as the Save More Tomorrow experiments in the United States, where you persuade people to give up a proportion of their salary increase automatically and escalate in that way.
Sure. Chris, if I could ask you to take up on that point, and there have been there's been talk in the UK market about Save More Tomorrow and incremental increases to pension contributions as pay rises come along. The idea's been knocking around for about 10 years. I'm seeing very little evidence of it in UK corporate schemes. Is it complicated? Is it doable? And does it solve the problem?
Well, there are a number of different types of scheme, I guess. I mean, in the UK, it hasn't really taken off, as you say. There aren't many examples in the UK. There are a few more in the United States where it really started out. And the kind of basic principle that people are much more willing to commit to put more money in at some point in the future rather than putting it now, actually, through research and tests that have been done in the US, seems to work pretty well. But only in a number of very specific circumstances. Generally, where it's worked really well, the employer has always been very keen to make sure that people get in. So there's quite a high level of employer engagement as part of it. One part that's quite often overlooked is that there's always, it works best where there's a lot of employee engagement as well. So even going as far as face-to-face discussions with an employee at the start of the process to get them to understand what they're doing and what they're committing to. And actually having face-to-face advice rather than just given something in writing actually has a very big impact on how many people actually commit to join up the programme.
But are the ideas being envisaged? Is it the other way around, that actually the default position would be that you would be opted into something that would incrementally
I think
increase?
That's what would have to be different in the UK context. Yeah. I mean, in the US, it's worked very well. You can get contribution levels up to even 15% or more on an individual basis without seeing significant opt-out rates. People tend to carry on within the scheme, allow their contributions to increase until they get to around 15%, and they don't either pull out of the scheme or stop making contributions in the vast majority of cases in those circumstances. In the UK, if we were looking at something on a nationwide basis, then obviously it's going to have to be fairly different from that because of the fact that you're doing it across a whole range of different employers for schemes which have different base level of contributions. And so I think the general idea that trying to find a way in which you can build on the way that people think and their kind of behaviours to get them to pre-commit something in advance is probably a good one. How it would work in practice, I think, probably needs a lot more work.
Right. And there's an additional interesting point there, Chris, isn't there, about how you communicate to people how much is enough. Yeah. If I say to someone, you need to walk to the next town, they might very well reasonably say, well, how long is it? How long will it take? Simply saying, well, you need to walk along the road, I can't tell you how long it is, but you need to go further, is not a particularly attractive message. And so I think as regulators, government, industry need to think about the mechanisms that they could develop to help people understand how much is enough so that you can actually have a target in mind. It's not an endless journey. And whether you can use heuristics, for example, if you're 30, you need to save X percent. If you're 40, generally you need to save Y percent, just to try and guide people and give them a little bit more of a tangible goal.
Yeah, I think that's a good point. Communication is going to be really important, especially because it's also very clear that different people are going to have different rates which they need to be targeting and different levels of contribution. I mean, the figures I was talking about earlier, with the kind of 50-50 chance or 1 in 3 chance for the median earner, depending on what happens with the state pension, was assuming someone was saving for best before 46 years. If people have career breaks, then suddenly that makes a very big difference. If you don't start saving till 40, you've got a 1 in 20 chance of doing it. So you have to rely on some fantastic stock market returns in order to do that, which may or may not happen over the next 20 years or so. But it's things like that where individuals are going to have to know more about what they personally need and their own characteristics, whether they're in a couple, whether they expect to be in a couple when they get to retirement age, all these kind of things, which will affect how much people need to contribute. And I think that's why you probably can't push contributions up too far. If you look internationally, the schemes that work really well, so the Netherlands, for example, it's not necessarily the design of the pension there that works well, it's because the contribution levels are high. They're kind of 20% split between employer and employee and government over there. Now, I think it's difficult to get to that level in the UK, and for some people that will be too much. So I think what we have to bear in mind is that there is still a kind of voluntary sector in the UK. So what we're talking about here is getting people up enough to get them close enough that they can be able to make up any shortfall by themselves, which might be through other saving, it might be through using their housing, it might be through carry on working longer. There's probably likely to be, as life expectancy increases, as healthy life expectancy increases, as people feel in better health in their 50s and 60s, people will actually be happier potentially to carry on working, work part-time. The new flexibilities around defined contribution pensions mean they can take part of their pension and still work. So I think we're going to see a lot more flexibility come up in retirement as well.
Sure. And Jim, if I can ask you about opt-outs, we've had very healthy levels of opt-outs. Obviously 90% roughly 90% of people have been staying in, but we've got very low contributional levels at the moment, and there had been pre-budget there was a concern that obviously as people got up to the full 8%, they'd realise they could give themselves a 5% pay rise by opting out. Now there's a sudden upswing in the appreciation of pensions, and they're a lot more attractive. Do you think that's taken that away?
I think the narrative has changed over the last 10 years or so, and one of the successes of the Turner Commission is that it said, look, here's a huge problem that society as a whole has to grapple with. Everybody has to deal with it and have a stake in fixing the problem. And I think that over time, politicians and that element of consensus that John talked about has helped shape the debate, so people think, actually, I do need to do a little bit more here. The idea of kind of paternalistic employers who will just look after you and everything will be fine without you needing to worry about it in your probably DB scheme, that's all, I think, gone out of the window. So I feel people are engaging more, and they do realise the benefits and the value of contributing more into their pension scheme. I think there is a link, though, between opt-outs and very low levels of contributions, because you don't really feel the pinch. Very often as well, in the companies who have already auto-enrolled their staff, they're very large companies, they might very well have already offered pension schemes before, so for lots of people it might not have made very much difference anyway. It'll be interesting to see what happens over the next few years. Hopefully wages will increase, hopefully people will feel progression in the workplace, so they'll feel more able to contribute to their pension as the minimum contribution rises. But also I think in that period it'll be interesting to see whether small employers are as engaged with their employees in making sure that they see the benefits and the values. There's a final related point to this, and that is the issue of trust in pensions. A lot of people don't trust the financial services industry, and that is a big problem for the industry and also for the future of savings if we don't do anything to tackle it. One of the challenges is they put money in, but they don't really know how much money will come out at the other end of the ether. So being very transparent about charges, being very transparent about what benefits are for you, what investment returns you'll like to get, I think is increasingly important to engage a whole new swathe of people who've not engaged with savings before.
Sure. I agree very strongly with that, and I think we, as part of this pension settlement, financial services working with government and regulators again need to move to a place where the charge is the charge. We don't have a discussion about what's the difference between an AMC and a TER or additional expenses, that there is a place where you can access on a reasonably predictable basis what you can expect to pay, full accountability for the costs that have been incurred in delivering that service, and also stronger governance mechanisms, both through trustees, the new IGCs, so that when you're saying to people you're taking an awful lot of investment risk, in fact, in pure DC, you're taking all of the investment risk, that those who are in the default solution and saying, actually, I want someone to look after this on my behalf, can feel confident that the decision makers are clear about the processes, the objectives, and making sure that over that 30 or 40-year savings period, money is managed in the best possible way, schemes are administered in the best possible way. So you get that combination of transparency, good governance, and then people are more willing to make a greater contribution, sacrifice consumption today for a better retirement.
Yeah,
but I worry about the complexity of giving too much choice. As Chris was talking about the lifestyle differences between individuals and so on. I mean, all that to encompass in a pension scheme is extremely expensive. And if individual tailored pensions, the future, and with your own pot and so on, it seems to me that we risk getting into a situation where a lot of people won't be able to understand or make good decisions on the basis of what's going to happen. And I mean, Now Pensions, with which I'm associated, is a subsidiary of ATP of Denmark, which does 80% of Danish second pensions. And the trick there is one scheme. One size fits all. Now, it goes against the Anglo-Saxon, they were the original Anglo-Saxons, some of them. Ironically. But I mean, it is rather more conformist and more dictatorial in one way, for our taste perhaps. But it seems to me that if you keeping pensions simple is the key, and certainly the Danish experience would be over about 30 years on average pay. You were significantly better off than if you were on a DC type scheme in Britain. And I'd like to see all the time us pressing for simplicity for employers, for administration, and for the individual concerned. You pay this, and we expect you'll get that. I know you can't say, as you rightly said, what the journey is going to end always. You can't be that precise. But you can say what happened before, and once you've built up a track record, and if you do this, this is what we think will happen.
But isn't the default strategy, John, a way of saying to people, actually, there is a single way for those that don't want to exercise choice? There is good governance. In a sense, what you're saying is we'll deliver through a default strategy the kind of good decision-making and the scale that you're talking about that you can deliver through an ATP-type mechanism. But you still give people the comfort that if they wanted to do something different, they could. Because what we know is that actually people like choice, but they don't necessarily like exercising it. So in a way, a lot of this is about giving people the reassurance that they can determine what they want to do, but actually knowing that in 90, I think even 95% of cases in many schemes, auto-enrolled individuals, including many who would work in financial services, will tend to go into the default because they want to go to something that has that strong governance and that reassurance for someone overseeing what is happening.
Well, I certainly hope you're right that people will feel confident about a default option. But I do worry about the fact that with quite a lot of people exercising individual choice, that the attention of the governors, the runners of these schemes, will be more at the individual who's trying to make an individual choice because of their own family circumstances, than perhaps making sure the default option is the main motorway forward, to use your journey analogy a bit further, but that is the main road, and you should pay for the detours that you might make. It makes it difficult for someone like now pensions and others providers who are on base level charges. And would like to see that will be an issue in the future. If you're exercising choice, you'll probably have to pay for it.
And Chris, could I get your perspective on this as someone who examines all the schemes in the independent pay, to the extent to which bringing in choice does increase cost? And also maybe if you've got a couple of words on what the freedom and choice brings that in, because suddenly providers have got to be able to hand everyone all of their money back from 55.
That's going to be an interesting one. I mean, I think what the discussion is bringing out is actually the importance of default, but both its strengths and its weaknesses. I mean, the strength is because the way that auto-enrolment works, the vast majority of people end up in the default scheme, in the default fund. So it actually does mean that, in theory, if the default is well designed, they're going to be doing okay out of it. There shouldn't be a problem. And I think there's a lot of truth in what Lord Monks was saying about how it works overseas, and actually just getting scale together also reduces cost as part of that, but it also means that people kind of are all treated in a similar way, which might iron out some of the differences you might see otherwise in a kind of individual type DC arrangement. But I think the problem with the default also, it's one of its weaknesses, is that it means people tend not to do anything else about it. They tend to assume that they're doing okay. They've been told they need to be in a pension scheme. They're in a pension scheme. They've been told this is a minimum contribution. They're making the minimum contribution. They therefore think, that's it, I've got a pension. And I think what's not happened yet is that kind of idea that, okay, I've got to start. Now what else do I need to do? And I think you're right, actually, Lord Monks, that it's not something that the default should try and take care of. It's not, you need to design a scheme that everyone does exactly the best they can do out of it. It's you need a default which provides a very good, strong base level, but then you need something on top of that which allows people to then decide themselves or be helped themselves to work out what else they need to do. And I think in a way this is where freedom of choice does come in a little bit. It's very early days at the moment. It's very difficult to see what impact the ability to take your pension earlier, the ability to take it as a lump sum, the requirement not to have to buy an annuity will actually make on whether people will save more or not, whether they will take money out earlier or not. I think there were a whole range of different circumstances involved in that. I think what it has done is, by kind of highlighting the difference between auto-enrolment, where things happen automatically, and now freedom and choice, where people have to make a decision. And kind of in order for people to be able to make that decision, the government has decided there has to be guidance offered. And I think actually opening up the idea that there's guidance available, whereas previously in the automatic enrolment guidance, engagement was almost kind of designed out of the system.
That's right.
I think now there's an opportunity for people to think, okay, well, if we need help there, is there a way we can make that guidance not just a one-off event, but more of a process?
Yep.
And how can we bring that to make that work earlier in the process, so actually people then have something they can make some choices with, have some flexibility with. If they've just made the minimum contributions, they're not likely to have much choice as to what they get at the end.
Sure. Interesting. Yeah, Jim, you wanted to come in there?
I think the budget was an inflection point for pensions. We've thought for a decade at least about accumulation and how you build your money. And what we've seen in that period is the introduction of Nest in particular, but also the new competitors such as now pensions, the People's Pension, at the bottom end, which has helped reduce charges very considerably. So charges in DC schemes, default funds, are much lower now than they were 10 years ago. A lot of that is because of the minimum level that was put in for Nest, and also that now and others have competed with. So accumulation we've looked at and brought down some of the costs and all the rest of it. Now, though, I think we're looking at the decumulation phase, and something worries me that we talk to government, talk to DWP, talk to Treasury, talk to others, and all the focus remains on accumulation.
Yeah.
So from the point of guidance onwards, what are the products that are available? What does innovation actually look like? How can we ensure people know what their best deal actually will be? That's probably not through the guidance guarantee, but that is through a way of engaging people with savings more generally.
Yeah.
So we're at a turning point. What the future looks like, I think, is very hard to tell. We don't know how people will behave from April when they are given greater freedom and flexibility. But what we hope it does is it brings down the cost. So that helps rebuild some of that faith in the idea that saving early in your life for later in life is actually something that will reward you more fully than people have thought before.
Valid points. We've not got much. Sorry, Jonathan. We've just got a question in, and I just wanted to run this by everybody because time is catching up with us, and we've just got time for one more question. All of you, should more people be included in auto-enrolment? I think the stats were that more people had been excluded than included, new into the scheme at the last lot of figures. Do you think that the threshold should be brought down to include lower earners?
I think it's a good question to reconsider in due course, because again, going back to Turner, the Pensions Commission were very clear about setting a low earnings limit as the starting point, because they didn't want to have a situation where people who would have a high replacement rate from state pension and might otherwise benefit from actually focusing on their current expenditure was saving for a future where actually you'd end up with a very small amount of money. That said, since the Pensions Commission reported, there have been quite a number of changes to the threshold, and it's now not quite as clear. And I think in due course, any initiative that can provide people with greater opportunities to save, but also the support to ensure that you don't save when you should perhaps be focusing on just your day-to-day expenditure, paying off debt, etc., get that balance right. And I think that will be a very positive step forward.
Sure.
I mean, I think it's interesting. I think this is one of those situations where something which seems very sensible at the time has had some very severe unintended consequences. So actually linking kind of the earnings level at which you start to become eligible for automatic enrolment with the lower threshold for income tax was an eminently sensible thing to do. We didn't want an income tax threshold, a national insurance threshold, a shadow national insurance threshold, and an auto-enrolment threshold. So actually just linking it to one of those made perfect sense. The difficulty is that kind of since political parties have started increasing the income tax threshold to reduce the number of people paying tax, a knock-on effect, which I'm sure hasn't been intended, it's not been a policy design feature, is far fewer people are being automatically enrolled, probably somewhere between 2 and 3 million people who would have been automatically enrolled, earning between 5,500 and 10,500. And if the Conservatives are re-elected, it goes up to 12,500. That's a massive part of the kind of lower earnings group to be taken out. Now, that wasn't done on purpose. It was just done as an accident. And I think the Pensions Commission were very clear. There were, if you're on very low earnings, which they said was around 5,500, maybe 6, you probably shouldn't be making contributions. But that group between 6 and 10, probably where it is slightly more affordable, where you're probably seeing more part-time workers, where you might be seeing people whose partner is making contributions elsewhere, so you might be looking on a household basis, so they might not be that short of money to pay it in. You might want to think about whether they should be or not. Now, I don't think there's a yes or no, they should or shouldn't be, but I think it is interesting that I think the last set of figures showed, although 4.4 million people have been automatically enrolled since 2012, 4.7 million people working for the same employers haven't qualified for automatic enrolment over the same period, and I'm not sure that was intended.
No, absolutely.
So we've got the situation whereby people right at the bottom of the earnings pile are the ones who are excluded from auto-enrolment. That's in a sense what we're left with. And I think the banding, whatever the logic of it was in the days of the Turner Commission, the logic for that has gone. And just one other thing, as we approach a general election in the not too distant future, I mean, the dangers of sudden decisions on pensions. I mean, I think the budget decision was a pretty sudden decision. There was no cross-party sense of support for that at the time. I mean, I'm not saying there's any serious opposition to it about annuities, but it was a big shock and a big surprise. And to pretend that we're ready to handle that in a smooth way for people from next April is wrong. We're not. And I hope that the politicians will just calm down a bit on the pensions front and not make promises which will have these unintended consequences.
OK, so we've got quite a view there that maybe more employees should be being introduced to auto-enrolment. That's obviously greater cost to employers. Jim, your perspective on that?
It is. It's a challenging one, this, because the consensus around the Turner Commission was very much that those people who have traditionally, historically been excluded from pensions are generally the low earners, and they're the ones who should be brought into it. But I think there is a balance to be struck, and I think we need to look in 2018, once auto-enrolment has been fully rolled out and everybody is offering it as kind of a minimum level, look again at what the actual costs and benefits are for people who are at the bottom end of the earnings spectrum. At what stage does it become advantageous to you to save in a pension, and at what stage actually is it just not really worth your while? Also, what are the economic knock-ons for employers? Is it in their interests and is it in people's interests that they increase, say, to pay above the national minimum wage for those million people who are earning that level and slightly above? Or is it better that they put that money into pensions? So I think we need to find that right balance, and I think time has moved on. The consensus probably has changed a little bit around this, largely because of those quite sensible changes to income tax thresholds at the bottom.
Yeah, great. Well, thank you all very much, and thank you for all of you who are watching. We don't have any more time, so I'd just like to say a great thank you to my panellists, and thank you for taking part, for those of you engaged online. Thank you very much. Bye-bye.